Welcome to a new PE Forum Fireside Chat. Today we welcome Eric Wiklendt, Managing Director at Speyside Equity, a middle market private equity firm specializing in complex, operationally intensive investment in the industrial and manufacturing sectors. Across our conversation today, he will share his insights on Speyside strategy, the evolving deal landscape, and the experiences that shaped his career. Eric, thank you for joining us today.
Thank you very much for having me. I really appreciate it.
So let's jump straight into it. And if you could tell us what is the overarching philosophy and strategy that you look into when you do distressed or carved out deals, and what makes you decide within the complex situation if it's still worth going through it?
Sure. For us at Speyside, it's really a combination of two factors. Number one is structuring, and number two is transformation. Generally speaking, we're looking for opportunities to buy manufacturing companies in the lower middle market, $100 million to $500 million revenue manufacturing businesses, where they're in some sort of misaligned ownership structure that causes them to be undermanaged and therefore underperforming. And we really like to find those businesses, structure them right, and then transform them using our Portco value creation system to first increase the EBITDA margins, and then secondly, grow the top line. So it's a bit of a fix and build strategy that we employ based on structuring the company properly.
And so there are specific cases that, makes a company more attractive. You mentioned management misalignment. Are there other cases where you see that you can bring value?
Absolutely. Really how we think about it is through the lens of our Portco value creation system, which is a very structured process-driven approach to value creation. There are two phases of that. Phase one is operational improvement, and then phase two is commercial growth. In the phase one part, we're doing a lot of things like aligning, incentivizing the management team, rationalizing the revenue portfolio, optimizing the operational footprint, things like that that are very hands-on in nature, but very controllable. And we'll tend to underwrite the deal to that part of the value creation, just the phase one, with the idea that we'd love to do phase two activities, which include acquisitive growth, and then also organic growth, like new product launches, new market entries, new channel entries, new geographic entries, things of that nature. But really, when we think about it, we're trying to make sure that there are clear activities that we can execute and control during our hold period that will improve the EBITDA of the business and the EBITDA margins of the business, such that equity value will be created. That said, we don't underwrite to multiple expansion, but a lot of our deals will get multiple expansion just because improving the EBITDA margins and cleaning up the company in a better structure allow for the next owner to really have that business as a platform if they're a financial sponsor, or easily integrated into a larger business if they're a strategic buyer.
Okay, it's very clear. And you've closed a fund this year and you've grown. And the question that comes along is, how do you maintain this hands-on approach that you just mentioned, and this operational discipline that what was your earlier in your stages the trademark of Speyside, when things become bigger and larger?
Yeah, good question. There's two answers to that. It's people and process. And the people part of it is a function of the fact that we really like to make sure we use operating partners on deals that can really be the project manager of the key deal theses, 3 to 5 deal theses that are going to create the value. And then the second thing is process. Back to that Portco value creation system, that's a very systematic approach, and it's very process driven. What we have, though, is it's not just one slide that is a philosophy. We have a ton of tools and frameworks and models and things like that we can give the management team to really speed up the activities. And it's a show not tell model, right? It's we don't tell people, hey, maybe you should, go think about doing this. It's a no, it's more, hey, we did the due diligence. You should do this. Here are the tools and frameworks to do it in case you've never done it before. If you've done it before, do it the way you like to do it. If you haven't done it before, here's a, sort of a paint by numbers approach to doing it if you just follow the process. So those two things, getting the right people in terms of the operating partner and the management team that can then use that process to execute the value creation is really, really critical. And it's very synergistic if you think about it, because with the right people that are talented and can understand those sorts of things, they can then pick up that process and those ready-made tools and frameworks and deploy them very quickly.
And would you consider acquisitions for companies that are larger than your typical revenue range? And if so, what approach would you take post acquisition?
The answer is yes. And we tell people 100 million to 500 million dollar revenue businesses, but that's a honestly, it's a quantitative heuristic to express a qualitative rule of thumb. The reason why we say 100 million to 500 million and we go with 500 million as the top end, it comes down to what are the characteristics of the company that we're looking for. The reason why like a certain size makes sense is that we want to make sure that the companies we buy don't have too much what I would call bureaucratic inertia working against us. Our sorts of deals where companies need to be transformed to improve need to happen fairly quickly. And the challenge is that when a company is a certain size, there are a lot of layers in the company in terms of management layers that are sitting between us and the people that actually do the work that customers pay you for. And we kind of think about it that customers pay you for really three things. For the kind of companies we buy, they pay you to make a manufactured good, they pay you to develop new products and services, and they pay you to do consultative-based selling to match their needs with the products and services that you sell inside of a solution. The problem is if something's too big, there's too many layers to get to those activities where a customer is going to pay you. As a result, we're not opposed to a company bigger than 500 million. In fact, we have some portcos, portfolio companies in the portfolio right now that are bigger than that. It becomes a question, though, of what's the culture of the business and how is it organized in terms of org structure and processes and people, and what are their attitudes towards creating value and potentially transforming the company to create more value.
Do you personally have a preference between a distressed deal or a carve out from a company or carve out from a distressed portfolio company? Do you have a preference?
I really, really, really enjoy deals that are challenging and interesting. So it's not any one type, whether it's a corporate carve out or public to private or debt to equity or family owned or things like that. I really get excited about businesses that can be improved, and how they come to us is not so critical. It's just I personally just get great enjoyment out of thinking about how businesses can be run a little bit better and how you can get the management team excited about doing those activities and whatnot. It gives me just I don't know, probably maybe maybe it's a little bit odd or but being able to see a company improve its EBITDA and EBITDA margins gives me great happiness and excitement. I kind of jokingly say sometimes I would do my job for free because I just find solving those sorts of problems really, really, really fascinating and interesting. And getting into do it with our team, we got a lot of great people that work at Speyside. They're super smart, super hardworking, great individuals. So getting to solve really interesting problems with really interesting people at really interesting companies is what really motivates me. So there's no any one way that they can come to us. Just the fact that we get to work on something interesting is what really motivates me.
And so when you finish your due diligence pre-acquisition, you probably know what are the bottlenecks, difficulties that you're going to face. Are you sometimes surprised that let's say these difficulties are quite easy and other things appear, or is it most of the time what you expect?
I would say that 60 to 70% of what we expect we find,
Mhm.
but then there's probably 30 to 40% of the time there are things that we didn't expect that we find. Some are good, some are not good. But we always find some things that we didn't uncover during due diligence or whatnot. It's just kind of to be expected, frankly, especially in companies that need to be restructured and or transformed. You're going to get that, but it's okay. It's part of, maybe I'm the weird guy that says this, but it's part of what I think makes it fun.
And if we look at the broader picture, what do you see as a trend or macro trend that are the biggest risks and the biggest opportunities for lower middle market manufacturing deals over the coming years?
I think the thing that is going to be most interesting are geopolitics. And it's several things going on at once. The most recent issue is the tariffs issue with the United States and the rest of the world. Um, I I think that needs to get solved here pretty quickly, one way or another. Just whatever is going to happen needs to be decided, and you know we need to get to a steady state. But I do think that you're going to see a reduction of globalization and a rise of regionalization. For us, that's okay because it probably means more business comes back to North America, and that's where we'd like to do our primary investing. So we think there will be an opportunity. That's number one. Then the other second big trend that we see is demographics. If you think about, generations is a good way to think about this. There's a lot of baby boomers out there, and they're retiring. So I've seen different statistics from different sources, but depending on which source you follow, what I see is that there's going to be somewhere between 40 and 80 trillion dollars of wealth that will transfer over the next 10 years. Several of the segments of that wealth are privately owned businesses and or holdings of privately owned businesses or control of privately held businesses. So we tend to think over the next 10 years, there are a lot of businesses that are probably going to get sold, and there are going to be some second, third, fourth generation family members that don't necessarily want to run those businesses. And, if they're in the manufacturing or industrial space, we're excited to buy those sorts of things if somebody else doesn't want to own them. And then I would say the third thing that kind of goes with trend one and two is just the rise of AI and robotics and really Industry 4.0 in the manufacturing and industrial space. As those businesses basically get sold or other businesses start up or they move back to the North America, the reality of the matter is we don't have the demographics in North America to support people making those products with their own hands. What that means is probably AI and robots are going to do a lot of that, enabled and facilitated by Industry 4.0 tools. So we're thinking a lot about that. And, you'll hear a lot of times like the tech stack. We think about it more as the process stack. And the reason why we say that is that technology is an input to that, but so are people and so are processes or activities, I guess I should say, and so is data. So when we think about that, we think that's going to be an interesting trend going forward. So again, three things: death of globalization for regionalization. Number two, demographics of society and the changeover of wealth. And number three, the rise of Industry 4.0 tools in our businesses.
Let's if we focus on the second point, which is the transfer of wealth in practice. How does that impact, in your view, the valuation currently? Do you see that the market has a high valuation, and is there competition for the assets you go after? How would you position yourself on this point?
For us, valuations tend to remain fairly constant just because we're oftentimes buying things that are a little underloved. So that helps. Whereas, like, I would say 3 or 4 years ago, valuations were a little bit higher than I think they should have been. And that was because debt was ridiculously cheap.
Mhm.
So you had a lot of people throwing ridiculous multiples at things. And the other thing that has been going on that's happened over the last 3 years or so is there's been a little bit of a reckoning in the private equity industry. And what I mean by that is there was a lot of money raised in the early 2000s and early 2010s because there was a lot of cheap money out there, whether it was equity or debt. Well, what you're seeing happen is a lot of those funds are not being able to raise funds currently. Th- I think that's a good thing overall from the perspective that it means that people are more realistic about valuations and why that's important. It's important to me anyway, and I think it's important to a lot of other people. It means that our LPs, the investors in our funds that do survive, they'll get a better return, which is, obviously our goal is to give great returns to our investors. So I think that's good, but I think that valuations will remain fairly reasonable going forward here. And for us, because of the niche in which we play, where structuring and transformation are needed, it tends to dampen the peaks and valleys of valuations for our strategy, which is really good, which that allows us to make sure we do our best for our investors.
And this applies to carve-outs as well as distressed deals.
Absolutely, everything, whether it's a corporate carve out or debt to equity, public to private, family owned, owner operated, or even owned by another fund. We bought some companies from other larger funds where it wasn't a fit in their portfolio anymore, or they had owned it a long time, or maybe they had some challenges with it that needed some operational know-how to get the company back on track. And we'll do those things too. And we'll even do things where because of our know-how, operational know-how, we'll leave the existing owner part of the equity in the deal so that they can get some upside after we've restructured it and transformed it, and that tends to work really well for folks.
You mentioned, things that are not a fit for larger funds within their portfolio. If you look at how you balance your portfolio, is it more geography, sector, or industries? How do you balance it?
Yeah, good question. So we really like to buy things in North America for this fund we just raised, or at least that's our focus. And then we're looking for things that are 100 million to 500 million in revenue where there's an opportunity for improvement. And then there's certain sectors that we tend to avoid concentration in. Those are automotive, oil and gas, and then anything with government stroke of the pen risk. Otherwise, any other manufacturing sector we'll look at. But those are important. And then we like things with decent collateralizable amounts of assets. We tend to do pretty simple debt structures to start with pretty low leverage ratios, usually like 2 to 3x. And the reason why we do that is because if something needs a transformation, it's really difficult for a management team to deal with a high amount of debt service and then also transformation at the same time. It's a little bit like fighting a war on two fronts, and that's usually not a good thing to do. So we don't do it. So those are the characteristics of what we're looking for, is kind of the right size, where there's an opportunity, where we see a clear opportunity to improve it. It's manufacturing focus other than a few industries, and then we can use simple conservative debt structures as part of the cap structure.
And for you, is there a specific sector within, the verticals in which you invest? Is there a specific sector that you think has a great opportunity for the coming 5 to 10 years?
I think that infrastructure plays are going to be sort of interesting over the next 5 to 10 years. I think it's gonna be a little bit like a fire. Bless you. Where basically it's going to kind of start slowly and then it's going to, grow. That'd be number one. And then number two is I would say engineered materials, right? There's going to be, if you think about like the next evolution of, I guess, kind of society, if you will, I think there's going to be a lot of opportunity for, engineered materials, especially in North America, to be improved, right? So it's like, instead of getting all of our aluminum from like Russia and China, why don't we just make the aluminum in the US? And the answer is it's a lot of energy costs and also it's a lot of environmental costs. But, we're pretty good in the Western world, whether it's North America or Western Europe, at solving those sorts of issues. We just need to solve them. And then the third thing is really, I really think I'm a huge believer in Industry 4.0. I just think there's a lot of opportunities to use those technologies to, process engineer what we call the process stack, which again is more than just the more than just the tech stack. It's also the people stack, and it's the activity stack, and it's the data stack. How does it all come together? And how do you use those things like building blocks to create scalable and repeatable processes that deliver better results?
Your area of investment is one of a lot of environmental and labor complexity. How do you position your deal sourcing and your capacity to execute with the current ESG and the regulatory environment?
Yeah, so with environmental, it's something we pay a lot of attention to. We want to be good corporate citizens. And so we try to make sure that we're doing that, number one. And then number two, it's interesting. A lot of the businesses, well, I guess all the businesses we own currently have some sort of recycling or circular economy concept in them. One of the businesses that we own, it takes slag, which is a waste stream from refining metal, and then uses that as a product or an input into the product they make. Another one takes MRF glass, recycled glass, and transforms that back into a glass product that it sells into the concrete and cement markets to significantly reduce greenhouse gases from reducing the need for cement in the making of concrete. And then another one that we own is a plastics business, and that business uses recycled plastic to make new products, new virgin products as well. So we're pretty focused on it. We want to, do all the right things by the environmental agencies, but then also take it a little bit a step further and use as much recycled material to be able to make the finished goods that we're making. And that really excites me about Speyside and doing that. It makes me feel really good that we do those sorts of things, and it's sustainable. And what I mean by that is that those products, we're finding a way to make them without any, not so much help from the government. We don't need subsidies to do it. So if that works out really well, I think it's good for the planet, because then, if we lead the way there, or at least part of it, then other people can do it as well. And, we leave our planet a better planet, when we all eventually leave it. So definitely a goal for us. And then we're also, to your point about labor, we've had really good luck working with unionized labor. We tend to find those folks to be pretty easy to work with in terms of what they want and what they expect. It's just a matter of having a conversation. So we've done that pretty well and pretty effectively over the years.
The companies you've mentioned are quite interesting, and I was wondering, do you also support or encourage them to expand internationally, or going back to what you mentioned of a re-fragmented and the end of globalization, you think that it's better for them to focus on the local US market?
We're happy with international expansion. Our portcos do business everywhere on the planet. Have manufacturing, I think, every continent except Australia and Antarctica. We'll probably never go to Antarctica, but maybe Australia at some point. We sell to Australia, but we don't manufacture there currently. So we're not opposed to international operations whatsoever. We're just looking for companies in this fund that are headquartered in North America, but we'll do bolt-on acquisitions anywhere in the world, and we'll open up plants anywhere in the world, or expand. Last year we had plant openings in Turkey, India, Brazil, Canada. So we're not opposed to international whatsoever. We think it's a great big world. It's just a question of how do you work in those countries to make sure that you're a good corporate citizen of their, an understanding of their customs and culture as well, and make sure you work within those constructs to be a good company on their soil.
You mentioned that you finalized your fund closed, and you discussed about the general environment that's quite difficult today. What do you think resonated the most with your LPs during your fundraise this time?
Three things. Number one, they were impressed with our track record in terms of returns. Number two, I would say they really liked the strategy that we're focused on. And then number three, the thing that I guess I was a little surprised, but we heard a lot of really good feedback on, is that they really liked hearing about how we approach things very process driven as a private equity firm. So we kind of run our private equity firm almost like a manufacturing plant, in terms of, we think of it as it's a deal making factory, right? And we think about, like, what are the processes we need to have in place, and how do we continuously improve them to keep creating scalable, repeatable processes that deliver the sorts of results that those investors are looking for. And as a result, it allows us to go find these deals that can be structured and then transformed, and then that's what generates the returns. And those were the feedback that we got. Those were really the three big things that they were excited about relative to investing in us, knowing that we have a very focused strategy. We're not generalists at all. We buy manufacturing companies very specifically, and there's very specific kinds of manufacturing companies that we want to buy. And when we explain to them how we do that, they really get excited. The fact that we think about it as a very structured, systematic approach to the activity.
Many LPs, tend to look at sectors or domains where there's a consolidation that could be done. You seem to focus a lot on organic and growth from within the company, if I'm not mistaken. Do you also look at consolidation opportunities, or is it mostly focusing on growing the company, solving their issues, and growing the companies organically?
We've done a ton of bolt-on acquisitions, over 30 at this point. So we're more than happy to do bolt-on acquisitions. Those work great for us. Just generally speaking, it's not in the first 12 months of the ownership of a portfolio company. It tends to happen after 12 to 18 months, because generally speaking, we need to get the company structured right, and then get it transformed properly such that it can be a platform. But then we are absolutely excited about doing bolt-on acquisitions where it makes sense. And a lot of times that's good for the industry just because when we do the bolt-ons, we're oftentimes bolting them on into a platform that's run a little bit better, and therefore we can offer better solutions to the customers ultimately by improving the company that we bolted on.
You mentioned people and the importance of people. If you take a general rule, is it more difficult to apply new management ideas or new technologies within a company that's facing issues?
That's a good question. I would say it really depends on the company to
Mhm.
which you're applying it. I think the technology is a little bit easier than the management ideas, generally, just because it's more objective. Generally, that's not always true. And then you also a lot of times have to do change management with new technology, but you also have to do change management with new management ideas. It's a really a question of like, can people kind of see the vision there and get around it or get their head around it. So it really depends. They're both equally challenging, but if you make me pick one, I would say management concepts are probably a little bit harder.
And if you look at your, operational background, how did it shape your investment approach, and which lessons from, running companies are most valuable in your opinion in private equity?
Yeah, so I will say it this way. It's a bit cheeky, but the biggest thing I think to understand relative to investing and maybe the way our industry kind of thinks about it is that there's no magical Microsoft deal manifestation fairy. And what I mean by that is just because you write something in a spreadsheet or on a PowerPoint deck, it doesn't mean it's going to happen in real life. Uh, Value creation activities and actual value creation is a function of executing detailed projects and with people. And that's the thing I guess I've taken away over my career the most is that it's pretty easy to write up a strategy or an idea. That's like 1% of it. So it's like 1% strategy and 99% execution. The strategy is kind of the easy part, right? The execution's really the hard part. And just because you write a strategy in an Excel LBO model or in an investment committee memo doesn't mean it's going to happen in real life. So the ability to actually understand how that's going to happen at a portfolio company is invaluable. And I'd say that's the thing that's a little bit special and unique about Speyside. Myself and my other two partners, Nick Lardo and Kevin Doherty, we've all been C-level guys at middle market manufacturing businesses, and we've all done operating partner work at middle market manufacturing companies. And we all have decades of deal making experience with middle market manufacturing companies. And that combination and interaction of those things allows us to take an integrated approach that allows us to go from thought to value creation by making things happen, and not just by writing it in a spreadsheet or in a PowerPoint deck, but actually working with those companies and the operating partners and the management teams to make it come to fruition such that the EBITDA margins and the EBITDA improve over a 3 to 5 year hold period.
You've mentioned your partners at Speyside, and if you look at how the firm has evolved, and you've reached a level where you're an institution and scale platform, what were the biggest challenges that you faced in order to reach that level?
Yeah, they were. It's a long and distinguished list, but to put it into a few key things, I think our Kevin Doherty founded the firm back in 2005, and he really did entrepreneurship by acquisition, and then it's been a journey from there. So from that perspective, like we've continually gotten more sophisticated and institutionalized while maintaining our entrepreneurial spirit. And there were a lot of challenges along the way, like kind of acting like a family office or an independent sponsor, where you're going out and finding money to do deals, or using your own money to do deals, and taking on a certain amount of risk and whatnot. But it's a good way to learn, and it's a good way to think, right? Because the thing is, like at Speyside Equity, that's really good about our culture is that we invest in our own deals. So it's we treat everybody's money like it's our own money. And that's really important from the perspective that you're never going to see us say something like in an investment committee, well, let's just do this deal because there's no risk to us. Like that's not in our DNA. And our money is where our mouth is. But I think the challenges over the years have just been to continually get more and more sophisticated, and then think a little bit better about risk-weighted returns. We've continually dialed in the strategy, reduced the aperture to get it really, really focused, and try to make a well-oiled, process-driven organization that creates that uses scalable and repeatable processes to generate great results. And the great result we're looking for is continually better and better risk-weighted returns.
From our conversation, you're a big believer in industrial 4.0, which means that you're a big believer in reindustrializing the US. So I want to be the skeptic and ask you, can the US on a manufacturing and industrial level compete again against China and other geographies?
My answer is yes, for two reasons. Number one, we have the resources, and number two, we have the culture. So from a resources standpoint, if you look at the United States, Canada, and Mexico, there are a lot of natural resources that are abundant, whether it's, basically the materials that go into manufacturing, or it is the infrastructure in terms of navigable waterways or roads or railways, or things of that nature. So we're pretty well set up there. We've done it once before, and we can do it again because the infrastructure exists for it to happen. The other, I guess, infrastructure or capital that exists that is probably the more important is the human capital. And what I would say that's, I think, amazing about North America, and especially the United States, is that we are probably the best country or continent ever in the history of the world in terms of innovation. If you think about how our economy and our form of government is set up, it's set up incredibly well for innovation and to take the risks needed to innovate. So as things move back, to your point, yes, we're probably not going to necessarily have people making products, but we will have robots and factory automation fueled by AI and other Industry 4.0 tools making products. And what I very much believe in is the United States, Canada, and Mexico's ability to very smartly and intelligently innovate based on the infrastructure that we do have. I think we will find the way. We always do, because I guess the metrics and the alignment of outcomes are set up really well to create incentives for people to do that. So I like our chances is the upshot.
Well, as Warren Buffett said, never bet against the US. I agree with you. So if we go back to your personal experience in the relationship that you build up with the management teams that you deal with in turnarounds or fix and build situations, how your experience helps them grow and develop as well.
Yeah, absolutely. It goes back to those those frameworks that we use in our portfolio value creation system. We have 27 of them. There's 18 in phase 1 and 9 in phase 2. And we're really able to help management teams and operating partners with that. And the reason why is because those tools and frameworks, we didn't just come up with them philosophically, we lived them in our previous jobs. And as a result, it's not just, I'm going to tell you what to do. It's, I'm going to show you how to do it because I've done it personally in the past. And that's always kind of like the best sort of coaching is from people who have been there, done that. We've all had those situations where somebody's tried to coach us in our life or job or, career where it's like they try to coach you, but they've never been in that same position. Been there, done that is a much better place to coach from as opposed to I know the theory. So we know the theory too, but we also have experience applying it. So that applied theory is really helpful to be able to coach management teams and operating partners on how to create the value. That's important. And then the second thing for us that's really important is that we really like to align incentives. So we create equity LTIPs in LTIP meaning long-term incentive plans. In every company that we buy. Usually that means that we're going to set aside somewhere between 5 to 10% of the diluted equity of the company for the operating partner and management teams, such that if we execute the deal theses that we're coaching on, that should create generational wealth for those people when we have a liquidity event.
And when beyond your role at Speyside, what motivates you personally, and what brings you joy in what you do?
Yeah, so it's two things for me. I just love solving the kinds of problems we solve. I just find it so interesting and it's so intellectually stimulating. It's kind of like playing the greatest game ever invented is the way I think about it or describe it. Then the second thing is like for me, it's nice to make a decent amount of money and all that, but I like to do a lot of philanthropy with that wealth creation. Um, I I joke a lot that I live a pretty boring life generally, because I guess there's some things that are important to me. It's mostly around people. It's not material things, but I really like to find ways to do philanthropy with disadvantaged kids, dogs, and then military veterans. So I like to find ways to give back to those groups of people. I feel like they need that. They need it more than I do, and I'm very happy with the life I have, and so happy to give it away. But yeah, two things. Like again, I love the work that I do in private equity, and especially at Speyside, and then because you get to deal with great people. And then yeah, number two is using the economic outcomes of those activities to help people a little less fortunate than myself.
To conclude our conversation, within the philanthropy side, you've mentioned the veterans, and do you also try to help them in professionally within the portfolio companies? Is this something that you can do?
Something we're looking at. We don't have a yet. We don't have a specific plan for it, but we love to hire people that serve their countries. They tend to be great folks to work with, and it's a little bit of a way to get back to them as well. So what we try to do is like if it's a tie between one person and another, like if somebody's a veteran, we'd have the tie go to the veteran wherever possible, just because we really believe in that. People they sacrifice to defend our freedoms and keep us safe, so they should get some benefit out of that as well in the workforce.
Eric, thank you so much for your time.
Thanks for having me, Khaled. I really appreciated being with you today.